Hello everyone. Welcome to this webinar. Sorry for delaying for the first 2 minutes. We were just waiting for everyone to join in. And today being Friday, we have scheduled as a process another webinar to continue, understanding what is happening, in the economy and world around us and how to continue the process and rhythm with aspiration of high performance investing, which is one of our business goals. So, we know we are living in an environment where macro attributes are like on one side, we are seeing interest rates rising to, I think, all-time high in maybe last 1.5 decades. And at the same time, inflation is also something which is, especially in the US and in UK, and now obviously in India, is kind of at a haunting number. So both these factors, whether it be cost of borrowing reflected by the rise in interest rates and inflation, ultimately impacts the profitability of any business, because business is unable to make higher margins because of inflation and is able to kind of not borrow money at lower rates because interest rates are high. So in such an environment, how do we identify businesses which, as per our belief and understanding of today's guest that we have, are continuing to give earnings growth rate of 20% and above, because that's the ultimate thing which stock market worries about. Stock market is a very, I would say, smart, wise, or cruel game. If businesses are kind of not performing, they will be punished very badly, but if businesses are performing, they will be rewarded also equally. So today, we really want to focus objectively on how to identify in the current context such businesses which are growing at 25% as a earnings rate. And we have one of my dear friends and industry veteran, Mr. Madanagopal Ramu, who represents Sundaram Alternates, which over last 10 years has built a great track record across their alternate products and the PMS products, and have been delivering good double-digit returns upwards of 17-18%. And absolutely, at that number, they have multiplied wealth by 6 to 7 to 8 times across various products. So obviously, he started his career as a head of research, and then now he's heading equity at Sundaram Alternates, which is a fund house which is managing substantial, I would say, quantum of wealth for HNIs in India. And from him today, we want to understand that, first of all, how does he see current environment, which on one side we see that interest rates are rising, and inflation is also rising, and markets are also close to the all-time highs. And from here onwards, how to identify businesses which are going to maybe keep increasing their earnings at 20%. He has created one presentation, and we are going to discuss this more from a perspective of a solution, because at the end of the day, we are here to kind of make utilization of our time. We're not just academically going to discuss this, but obviously we are going to discuss in form of a portfolio where such ideology has been followed and is being followed, and we will obviously then reason it out in form of questions and answers after Madan has done his presentation. So without taking much time, I will hand it over to you, Madan. Formal welcome for this webinar. As and when you are ready with your opening remarks, I will then maybe start the presentation for you to kind of carry on.
Sure. Thanks, Kamal. Thanks, PMS AIF, for inviting us for this presentation, and good evening to everyone who have joined for this presentation. As Kamal mentioned, this is a very important topic and is very close to our heart, because the entire PMS operations in Sundaram started with a product called Sundaram Secular Opportunities Portfolio. And the key motto behind the product was that as the markets are so volatile and the dynamics of the markets keep changing, in the longer term, our belief is, if you can identify a set of few businesses which have potential to grow for many years, the growth for 1 to 2 years is not it's not a very tough job, but there are only few businesses or only selective businesses which have been able to manage 20% sort of a growth for a very long period of time. And if you can identify such businesses and invest, there would be not many of them. So if you can select such businesses, say 10 to 15 such businesses, and invest into them, and then just focus on the earnings of these companies, then in the long term you have a substantial it builds up a substantial capability to beat the market by an impressive alpha. That's the basis fund by which we started this portfolio. So the entire approach was like, what are those companies, what are the qualities of those companies, what are the qualities of the business, quality of the financials of the business, and what is the quality of the management that we need to pay attention to before we end up saying that this is a secular opportunity, secular portfolio, or a secular stock where we can bet our money. And obviously, such names are not so widespread. We run a very, very concentrated portfolio in this strategy. 15 stock is what we say. Periods in which we have run only with 10 stocks, and periods where we find some additional opportunities, we have increased it to 15 stocks. But predominantly, the thought process behind this portfolio strategy is that go and identify those businesses which have potential to grow 20% over a very long period of time, and ensure that you don't buy them at higher valuations. You buy them at a reasonable valuations. Most of the time, you are not going to get these stocks at a cheap price. There are instances where we have bought them at a reasonable price, but not many a time these stocks are going to be available, say at a low PE. Most of the time, these stocks are going to be at a higher PE, and some periods you might get them at the reasonable price. So the entire thought process is that you buy these companies at a reasonable price, but ensure that these businesses have potential to grow for a longer period of time, at 20% or so. Then you have a great chance to beat or create alpha over a longer period. That's the precise. That's the introductory remark I wanted to give. Why this 20%? A lot of you might wonder. The reason why we say 20% is, if you look at Nifty's earnings in the long-term basis, it is around 10%. And if you are getting, so India's GDP is around, say, probably growing closer to a 6% sort of a real GDP, and Nifty's earnings growth is around 10%. If you, not many businesses are going to grow consistently over 20%, right? So there will be those selective businesses, and 20%, which is double the Nifty's earnings growth. Even if you end up paying a little bit of premium on valuations, you still have a great chance to multiply your money. The targeted return that we keep is anywhere between 15 to 18%, depending upon the portfolios that we run. But if you have a portfolio which is growing at 20% in earnings, then even if one or two stocks don't go the way you expected, or the businesses don't go the way you expected, you still end up creating a return which is around 15% plus. And that should be a reasonable 4 to 5% alpha over the Nifty from a long-term perspective. So just that's the premise with which the strategy is run, and the research is about searching for and identifying such companies. So I'll take you through on what are the criteria that we use and why we use those criteria, as well as I will also take you through some examples on what has been some of the companies where we have used this, and what alpha they have created in the last say so many years. So can you move next slide? Move one more slide. So this is that portfolio. Can you go back? Can I handle this?
Yes, absolutely, Madan. You can handle this yourself.
Oh, thank you so much. So if you see this is the portfolio, and this is what the since inception return generated by this portfolio. The portfolio has created almost 8 times wealth multiplier compared to 3.6 times by the benchmark. So the people who came and invested, say, 50 lakh in CSOP in 2010, they've seen their money multiply by 8 times to 2 crore, while the benchmark would have made it, say, closer to sort of 1.5 sort of a number. So there has been a reasonable wealth creation over a longer period, and the reason why this was possible is the strategy that we followed, that identify those few businesses where the long-term earnings potential is substantially higher than the overall market earnings potential. And if you can kind of identify few of those businesses, invest into them, then you have a great chance of beating the benchmark by a meaningful manner, and create a large difference to the wealth from a long-term perspective. There are years where it can get challenged, but I think in the long term, markets move and the stocks move and respect the earnings, and therefore, if you have a bunch of stocks where the earnings growth is going to be substantially better, then you have a great chance to beat the benchmark, is what the basic premise is. I'll just explain you, take some time. This is the slide, which is an important slide. I think it will lay the foundation of what we want to say. And I will link this to some of the ideas also. But let me just give a gist of what it is trying to say. So it all starts from doing a research in identifying companies which can grow 20% or plus over the next 4 or 5 year time period. That's where the entire thing starts. So what are the few questions that you have to ask before you conclude or reach to this conviction that yes, this company has a potential to grow 20% over the next, say, over the next 5 years or so. First is, I think this company should be part of a trend which is emerging. That is very important. So I will discuss about a few trends that we identify. We think these trends have potential, and companies which are participating in these trends have potential to grow for a longer term. So I'll come to those trends, but before that, I'll touch upon some stock specific things that we can look at before entering into the trends itself. So from a purely stock specific, what we look at, first thing that we ask is, if a company has to grow around 20% for the next 5 years, we are asking for companies which will almost do 2.5 times the earnings of the current level, right? Their revenue should be growing at least 2 to 2.5 times, or the margin should expand. So predominantly we look for companies where the top line itself can double in the next 5 years. If there is a margin benefit on top of it, then it helps us further. So we look for companies where the revenue itself can double in the next 4 to 5 years. In that way, we look for companies where the target addressable market is huge. So if you take any of the companies, even large cap companies, these companies can be in large cap, it can be in mid cap, or it can be in small cap. But the basic criteria is the potential for these companies in terms of addressable market should be substantially higher. For example, let's take a stock like a large cap stock like and even Titan, which is there in this portfolio. Titan might be a largest jeweler in India, but Titan is looking at a market of around 5 lakh crore and with a size of around 30,000 crore jewelry business. And they are into watches, they are into wearables. If you add all this, clearly Titan is looking at, and even recently they've added saris. So the target addressable market for Titan is almost as high as 10 lakh crore, I would say. And the company is just around 35,000 crore, including other businesses. Jewelry is 30,000 crore. Other businesses will be another 5,000 crore. So over there, it is a 35,000 crore business in a 10 lakh crore market. So that's a huge market, right? So we have to first convince ourselves that the market opportunity for the company is substantially higher and compared to what the current size of the company is. Another example that I can give here is, for example, we have a company called AU Small Finance Bank. Or even Astral Poly. In AU Small Finance Bank, the target addressable market, they are predominantly into vehicle financing and into small business loans. These are space, this total addressable market, if you look at it in India, it is close to 15 lakh crore in just these two products. So the company is just 30,000 crore in this 15 lakh crore opportunity. Obviously, there are segments of this market where private sector banks are very active, and therefore the profitability will not be very high. Therefore, AU may not be looked at. But even if you remove 50% of the market, even the remaining 7,50,000 crore is a substantially higher market and predominantly dominated by NBFCs. So there is a huge market in 20 times the size of the company that is there available for the market, for the company to kind of grow. This point is very important for you because if you can find a company, but the company is already well penetrated and the addressable market compared to the company size, the addressable market is not very big, then you run a risk of not able to identify a company which can grow for a longer period of time. I'll give you the other side of it. Just look at FMCG companies, like for example, Marico. The Marico's the largest product is air oil, and the company must be having a decent market share in the overall air oil market. And air oil market itself is not growing, and the company has a very large market share. Marico is a wonderful company, has been run very well by the promoter for the longer period of time. But of late, the company has not been able to grow. For the last 3-4 years, I think my company has not been able to grow. The reason is the same. Britannia, a super company, huge market share in biscuits. When the biscuit market itself is not growing, and this company has a large market share, and the total addressable market is not very high compared to the current market size of the company, you have started seeing problems of growth already. So this has to be kept in mind. The company can be wonderful, company's financials can be wonderful, but at the end of the day, if the company is working in segments where they have already well penetrated, if the industry itself is not growing, as well as the company is well penetrated in that space with a very high market share, then you have a serious problem that it can be a wonderful business with very good ROCE, but it still may not make a sustainable high revenue growth for a longer period to come. Then it becomes like a slow growth sector, defensive sector, and then we avoid those names, because creating a 20% return portfolio with the defensive sector is not going to be possible. So that's the first point that I want to say. Just keep this in mind. We will look into some of these examples also. Second point that I want to say is it should have some strong business fundamental, right? For example, opportunity can be huge. This is the same opportunity what AU has or what Titan has. It is the same what a Tangamail has, or also a Kalyan Jeweler has. Why is it then Titan has grown superior compared to a Kalyan Jeweler or a Tangamail Jewelry? This is a very important question that you have to think through. The reason is, if you look at Titan's ROCE, it is much superior. Titan has been able to sort of charge a higher margin for its product. The higher margin can be for brand or for the customer service or for the kind of unique designs that Titan brings on the table. It's a case for Titan. And also for most of the companies that we see in our portfolio, cost leadership is the most important criteria for differentiation. For even if you look at AU Small Finance Bank, cost differentiation is a very important. Cost leadership, I would say, not differentiation. Cost leadership is the key product. Now, why I'm saying this? AU is not the cheapest cost deposit taker in the market, because PSU banks and private banks get a lot of retail CASA as well as deposit, which will keep their cost much lower than AU, at least for next 5 to 6 years, in my opinion, or even for next 10 years. It is not easy for AU to match this kind of a cost. But AU is not competing with these companies. AU is competing with NBFCs. And already it must be having an advantage of 100 bips. And as the interest rates go up in the next 2 years, you will see the advantage only widens. So this, for the market segment that AU operating, the cost leadership helps AU. This is the sweet spot, right? Same thing if you look at for Titan. In addition to margin that they are able to charge, they also can hedge the inventory. Because in the jewelry business, you have to maintain inventory and you don't take exposure on gold prices. So you have to hedge it, right? The hedging cost for Titan is the lowest compared to all the players in the market. If you look at other names in our portfolio, an interesting name that we have brought in, Navin Fluorine, in our portfolio. If you look at Navin Fluorine, everybody thinks Navin Fluorine is a chemical company, but what is it Navin Fluorine is offering to the global to others, such that it is getting such large number of projects? Navin Fluorine is able to offer a low-cost R&D and low-cost manufacturing. See, low-cost R&D in specialty chemical is not like a low-cost offering in a textile. Low-cost textile is something which is easily competitive, given, say, even our neighboring countries beat us, and that is the reason why our textile sector has not actually become bigger. And even companies within the textile space, except for 1 or 2 names, you have always been very, very cyclical sort of a business, right? They benefit sometimes with large orders, sometimes orders don't come through. Actually, we have lost market share meaningfully to Asian nations as well as to some of our neighbors in some of these sectors, because the low cost alone will not save you. In IT sector, India has created a huge return over a longer period of time and grown multifold. The other sector where we think India can similarly do, and our Indian companies can do, like Navin Fluorine, is specialty chemicals. Here, the market You don't compete with these Asian nations or even with our neighbors, because here you require high-skilled R&D along with manufacturing. So our companies like Navin, PI, SRF, they participate in these global projects to identify new molecules or a better way to manufacture an existing molecule in the R&D phase. And then when these products commercialize, they also get the projects to manufacture these projects. And this positioning is very important. So that is the differentiation. Only when a company is in that sort of a sweet spot, either a cost leadership given its competition, or a cost leadership to capture global market, or a brand which gives them an additional power to charge to the customers. That sweet spot should be there. So every business that we look for, we search for the sweet spot. Only when we are convinced that there is a sweet spot, then we start getting interested in that stock. So first is there should be a huge addressable market, and second, there should be a low cost ability to compete. So you can ask me, like, there are other companies also which have these sweet spots, like for example, we don't generally are capable of identifying such sweet spot in or such growth companies in commodity companies, in energy companies. That's what we have highlighted here, and which we have always kept away from. And also slow regulated companies. In a regulated company, you can be the cheapest cost manufacturer. Like for example, NTPC. NTPC manufactures power in India at the lowest cost possible. Obviously, some of it has to do with government supplying coal to NTPC at the lowest cost possible. But at the other end, NTPC does not have any pricing power, and therefore they work on a fixed IRR model. So the IRRs also get reduced given the delay in projects, and overall. That led to a situation that NTPC and also the market, end user market, is not growing in double digit, and the company has a predominant market share. I think the largest guy supplying coal based power to the entire India, right? So although being the lowest cost manufacturer, there is no scope for this company to create value, primarily because the pricing power is not there, as well as the end user industry is not growing. So that's why we keep away from utilities predominantly. And also metals which are global cyclicals. It is very, even you can have a low cost manufacturing, I don't think you'll be able to beat China in manufacturing. It's very difficult for Indian companies in the metal space to kind of challenge global cost competitiveness in China yet, in my opinion, in a large scale, because of the kind of scale benefits that China has. And also to do in many companies in the commodity chemical space, or even in the other commodities, we feel that India's competitiveness is still not so great. So that is the reason why we avoid many of these companies. Also, predicting this global cyclicals becomes very difficult. So even within chemicals, the reason why we kept away from commodity chemicals and focused on specialty chemical is precisely for this reason, because it is easier here, and therefore able to predict it is also much easier. So you need companies which have a huge market in front of them to grow, and you need companies where there is a sweet spot for them to keep growing. So all these are there, these important ingredients are there, but very importantly, the companies have to have the capability to keep investing, right? So that's where our financial criteria come. These are not rocket science, very, very simple, but just we ensure that the companies meet this criteria. That's very important, because you can have a large addressable market, you can have a large, you can have a case also, but if you're not in a business which is already doing good profits and cash profits, then you don't have chance to kind of gain market share. For example, like Titan can have a large opportunity in the jewelry market, but at the end of the day, if Titan does not make even 10% ROCE, how will Titan make use of this opportunity? That's a very important question. So Titan should be making 20%, 25% ROCE, and not just ROCE, it should also convert into cash, and it should not get stuck in working capital, which is very important. So we look for within sectors companies where it is here where within sectors we get into specific companies also, and historically try to see whether these companies have ability to deliver a 20% ROCE. So any company which is not able to deliver this, I have mentioned here 15% ROIC. Right now the portfolio has companies where the ROIC, overall portfolio ROIC is around 20% or so. So the reason is why we look for this. Obviously, if you have to grow at 20%, you need to have the every incremental money spent on this business also has capability to generate a 20% sort of an ROIC. For example, if you take Titan's ROIC, it will be closer to 25%. Because it makes closer to 13% margin in with an asset turn of close to almost 3 times. So that leaves a pre-tax ROIC of close to 35%, and post-tax even closer, above, much higher than even 25% that we target for. Within banks, we look for at least companies which makes 1.5% ROE, because banks are highly leveraged business. Less than 1% ROA gives no scope at all. I will discuss about this in detail. But look at our names here: Axis Bank, ICICI Bank, HDFC Bank, AU Small Finance Bank, Bajaj Finance. All of them have close to 2% sort of an ROA at this point of time. And that's very important, because for banks, current year profits are the capital for the next years, right? So we need 1.5% plus ROA, 10 times leverage, leading to 15% plus ROE, so that they can keep growing 15% minimum. Obviously, as I said, the current portfolio has 20% ROE businesses, so they make 1.8% plus sort of an ROA, 10 times leverage, 20% sort of an ROE for many of these guys, and that ensures that sufficient capital is there for banks in our portfolio also to keep growing every year, and don't get stuck like what happens with typical PSU banks. PSU banks run a very low ROA structure, 0.5% to 0.6% sort of an ROA all the time, unless look for a 0.7% and get disappointed. So 0.5%, they leverage almost equivalent to 12 times because of home loans and all, and agri loans, priority sector lending and all, and therefore do somewhere closer to 0.7 or 1% ROA. But imagine in a bad year, this 0.5% ROA can shrink to 0.2% or turn to loss. Then they don't have capital for next year, and they don't grow for 2-3 years. So that is why we look for this minimum required return from the business, and also look within sectors where this comes and pay a lot of attention to it, and that's what will reduce your headache, and also your you don't need to keep on searching for such companies, right? Once a company is in that sweet spot and capable of generating a 20% plus ROE, and you don't have too much competition for that company, and it is a market leader. It may not be a market leader, it can be in a sweet spot also, like what AU is in the banking space, like what Navin Fluorine in the global chemical space. Navin is not a global leader in chemical space, but Navin has the sweet spot of offering a low-cost R&D at the and low-cost manufacturing for the products that they can contribute, as well as can do this with a good ROIC. Navin's ROIC is around 25%, and it is continuously getting projects where the ROIC can be maintained. So that then comes the next part. The current profits of the companies should be substantially better, so that that cash can be reinvested, and that is called self-sustaining model. So they don't depend on dilution unless they want to grow really fast, and they also don't need. One more thing that I pay a lot of attention within sectors to identify quality companies compared to others is, like in chemicals, you will often see different companies have a different working capital days. Like we have a name called PI in our portfolio. There is another company which is in the same sector and even claims to be closer to PI in terms of capability. But if you look at the other company, the working capital days is 500 days. I don't understand first a business where the working capital is 500 days, whatever be the explanation. But imagine in the same business, PI works with 80 days to 100 days of working capital. How is it possible? The only way it is possible is PI must be doing much substantially different from what the other company is doing, and should be having a bargaining power with the client, with whom the client is same for the other chemical company as well as for PI. And how is it possible that PI or Navin, these guys don't face such high working capital situation? The reason is there isn't value add. And that value add is what I'm trying to explain through the specialty chemical nature and the low-cost R&D and low-cost manufacturing that these companies offer to the global players. And so that is what helps these companies to get projects also at a very good ROIC. So there is a large market. There is a sweet spot for these companies given their cost leadership or given their brand. And the third is they have financials, they have the current balance sheet and the profitability in the existing business, which helps them to kind of reinvest back that money at a higher ROIC. This point I will dwell further. You can find a good high ROIC company, but if the company's growth or prospects are not big, that's where my first point comes. If the company is already a leading market share and the company, the sector in which they operate is not growing, the company has to quickly search for another sector where they can succeed. And if they fail in it, then it doesn't lead to growth. But importantly, if the company can identify growth opportunity within the sector, then it becomes much, much easier. So that is the reason why we look for companies where there is a large addressable market. And if they have good profits, they can keep reinvesting into the existing business, which is a fairly tested model, right? The company has already done success in part of the country, or they have done success in India. They can go global, or they can be doing very well in south part of the country, and they can move to other. They have done particularly well in a particular state, and they are moving to adjacent states or newer regions. So most of the companies that we have in our portfolio are growing because they have been very successful in a particular state. Like for example, AU was very successful in Rajasthan, and they moved into Maharashtra, Madhya Pradesh, Gujarat. Now they have gone to NCR, Punjab, and even HP. They are planning to go to UP. Probably South is a big market, but there are competition in South, but they will come to South also. So so that's the kind of growth prospects that they keep, that having done successful in a particular market, they move to adjacent markets and cluster based. So that is the kind of roadmap in front of them, and with the superior profits that they're generating, they will be able to grow by investing back into the business. So this point is very important. Don't confuse this with saying that I'm betting on companies with high capex. Yes, capex is very important for us to get convinced that these companies can keep growing for many years. But importantly, those capex should translate into high ROIC also. So the capex efficient use of this capital is also checked. And that is why we question these managements on when they get new projects, what is the kind of profitability in those new projects and why they are getting those profitability. And despite this high inflation scenario, can they protect their profits? So look at, despite this high inflation, look at the margins for Naveen in their existing and new projects also, or even in that case PI or SRF, or even for Titan. They all are able to price, and they are able to keep maintaining their margins, which is a most important factor. And that enables them to, when you have projects coming continuously, then by reinvesting the entire cash back into the business, whatever you generate. Say for example, you have so a business which is using a capital of 100 and generating 20% ROIC, so 20 rupees they generate, and reinvest the entire 20 rupees back to the business and generate a 25% ROIC on top of it. This helps the company to keep on growing 20% every year. So to first come to a conclusion whether they will get projects of this nature for the next 4 or 5 years, this entire framework helps us to identify them. And then the third is, you can have good opportunity. You can have you may be in the sweet spot. You might be having the best balance sheet and profitable business. But at the end of the day, if the company lacks focus and the management lacks focus, then I think nothing can save us. So we then bet on the management and who are able to do this. And the way that Titan has executed, even Avenue Supermart, which used to be one of our key holdings in the business, because of valuations we had to reduce. Look at Bajaj Finance, look at AU, look at even Naveen Fluorine of late. Even in some of the mid-cap names that we own, look at Trent, which have grown so fast, so big. The management, all these managements have been able to deliver on their execution. Their execution has been impeccable. So that is the most important part of all this that we are talking about. So we lay a lot of emphasis on what the management say and what they do. Some of it has gone wrong, but we try to keep those mistakes as low as possible. So even if of the 15 companies, 2-3 names don't go right, it has happened for us also. But even the remaining 10-12 does really work, then I think we are through. And that's what helps because here you are betting on the management. Like for example, Astral Poly. Astral Poly is in CPVC. Actually, it has a very large market share. So you might question me, it does not fit into the first criteria, that's a huge scalability, still has scalability, because in the overall PVC market, CPVC is still around 20%. So there is a long way to grow in CPVC itself. And but in the CPVC market, Astral Poly has a large market share. So here Astral Poly will gain from CPVC growth or penetration, while the overall piping business may not grow in double digit. CPVC penetration will. But what this company has smartly done is they have diversified into adhesives. They have diversified recently into even sanitary ware, faucets, and the paint sector. They may not become a very large player in paint. They might become a reasonably good player in sanitary and faucet in 5-year time period. They also have entered into tanks. The moment you add all this, we are looking at a company and the addressable market which is substantially higher. This is where management comes in the picture. So here the management is focused on growth, and they are continuously looking to identify opportunities. So when the same thing was tried by many other businesses, I think they have not succeeded. Like for example, I touched upon Britannia, right, Marico. When Britannia tried to replicate the success in biscuit in other food products, I think it was not very easy, and they could not translate into success quickly, and that is reflecting in the growth of the company. Same thing with Marico also. What the success they did in oil, when they tried to replicate in other new products, it was not coming through easily, and that's the reason why they could not replicate this growth on a continuous basis. This is where ability of management to adapt and then identify lucrative opportunities also comes into picture. So sometimes we need to take a break and look at whether this new products that they are entering, new regions that they are entering, can they replicate the success that they have done in the history? That's a very important point that you need to think through particularly when managements are growing outside the core business. And most of our companies have a very strong core business, and then they are slowly starting to move into adjacent products or adjacent regions, and that is how mostly the growth is defined. And the execution of this growth is backed by good financials and backed by various aspects that I discussed before. So this is in nutshell how the entire research process happens to identify these companies. Some recent companies that I can think of which have come into this. If you're looking for large caps, you're not going to get this 20%, entirely 20% growth models. Out of 50, Nifty 50, I can't even think of 10 companies which can meet this kind of a criteria. So therefore, your portfolio should be a mix of large cap, mid cap, and small cap. And in mid and small cap, it is very, very important that you need to be very, very careful about which business you are betting in. And most of the time, these businesses should be part of the emerging trends in the market. So now let's move to some trends that I talked about, right? Where we find such companies where they are benefiting from the trend itself. And therefore, if you have a good company with a good financials and they are participating in that trend, you can be a little bit assured that, yes, there can be a growth in this business from a long-term perspective. So let's move to this themes. So this is the 4 themes that we play in, or 4 trends that we see where you can identify. So it's not like trends and you invest in any company in these trends. No, you have to then filter out those companies based on the 3 quality criteria that I mentioned. And that is how you can come to a conclusion on which stocks that you can buy. So let's take 2 of them. I'll probably we can share this presentation, but let's spend time on 2 of them. Others I'll just touch upon, but I'll give a gist of why these trends are long-term trends and the high growth trends. So to identify a 20% growth model, first these trends should be very strong and highly differentiated compared to the overall growth in the economy, right? So that is very important. Let's see this financial inclusiveness. So why we always kept out of PSU banks? So one side I can say that PSU banks have a lower ROA, therefore we kept out of it. But the other side is the private sector banks are very well equipped to keep gaining market share from PSU banks. Why? Because of the superior service as well as superior profitability, because private banks focused on retail banking. Retail banking is not as easy as wholesale banking. So the branches have to be well equipped. The branch employees should be motivated that they move out of the branch and search for opportunities and bring those opportunities, right? or you should be working directly with the customers who can pay you a much superior margins compared to corporates. So obviously corporate banking ROIs are lesser and spreads are thinner, and also goes through cyclicality. That's what we saw with the corporate NPA cycle in India, right? Between 2014 to 2018, or even up to 19, that all these PSU banks and even some of the private sector banks like ICICI and Axis, they went through this huge corporate NPA cycle, right? So that is the reason why it is important to focus on granular book and focus on retail book. Now Axis and ICICI have transformed a lot. They have cleaned up the book. Now they are starting to make use of their superior CASA deposit and cross-selling opportunities, which they gave the opportunity to Bajaj Finance, in my opinion. And now they are also coming back and then focusing on these opportunities. And so when you look at the large cap banks, the key points that you need to keep in mind and the trend that you keep in mind is they have potential to continuously keep gaining market share. If the India's GDP growth rate, real GDP growth rate is around 6%, the nominal GDP growth rate can be between 10 to 11% given 5 to 6% inflation. Today it is high, but on a sustained basis, we see inflation in India anywhere between 4 to 6%. So you add on top of it, because banking also benefits on top of the inflation. The inflation should be moderate, it should not be very high, but it benefits because the total loan value jumps because of which. So you can look at a 10% credit growth. It sometimes can be 1.2 to 1.4 times also, but let's take 1.2 times. So 12% sort of a credit growth. If 12% credit growth is there, retail will be minimum growing 15-16%. So if retail is growing by 15-16%, because the retail penetration in credit penetration in India is fairly very low, and still there is a large unorganized market, and still there is a large NBFC market also, and therefore the retail penetration in banking always grows at around 15-16%. And now you have companies within this who have capital which is growing because of good ROA at around 18 to 20%, like HDFC Bank, Kotak Bank, ICICI Bank, Axis Bank. I think these are companies which have now, probably Axis and ICICI 3 years before did not have this kind of a profitability. Now they have cleaned up and they have now seen focusing on retail book, and they have built a good credit card book, personal loan book, by just cross-selling to the clients in their own banking network. These are very profitable when you are doing cross-selling, and that is how they have transformed. Now you can see the numbers for Axis and ICICI. Every quarter their NIM margins are improving, and they have touched 1.8% ROA. Even ICICI Bank touched 2% ROA last quarter. That's a very big achievement, because 4 years back we were looking at less than 1% ROA for ICICI Bank. That's a phenomenal transformation. Believe me, even getting your ROA up by 20-25 bips is a very tough task in such a competitive market. So for a bank to transform from less than 1% ROA to 2% ROA is a phenomenal achievement, in my opinion. And that's what we played ICICI for, and that's where the process in Axis also, I think. So that's what HDFC did for so many years. That's what Kotak did. But today, I think given valuation as well as this growth, some of these stocks look really good. See, one is they have been always gaining market share from PSU banks, and PSU banks form almost 50% of the banking system still. So if they don't grow and the system is growing at 15%, now you can do the mathematics to understand that why I say 18 to 20% growth for private banks is always doable and sustainable. It is not like 1 to 2 years. They can do this for another 5 or even 10 years also, in my opinion. Unless they become really big in some segments, they have to slow down. So second thing they have done now, that as they see some segments are slowing down, they have gone granular. So this is where they're now starting to compete with NBFCs. So already I'm seeing HDFC, Axis, ICICI very active in SME space. But here we require a good underwriting capability. And trying to do it at the branch level sometimes hits you. So you need a digital capability by which you can underwrite all this at the centralized level. So I think many of these banks are investing now and investing in technology, and you will see the benefit of those, that they are able to lend to SMEs, at least if not small ticket SMEs, at least they can come down to as low as 50 lakh to 1 crore sort of a book. And I think that's a large market. It's a huge market. And here NBFCs or small finance banks, They have been very active. So they will go and challenge these spaces. And technology is going to help them. They've already invested in technology. And if you see ICICI Bank's Instamart, it's a great product to onboard any SME. The moment he's onboarded, you have access to his CASA, and you can also give working capital loan to him. And that's a great ROC product because you are getting a low-cost deposit and you are giving him loan. Imagine you can get a car deposit from him without any cost, and you can lend him at around say even 10-12%. Probably he's getting it right now from NBFCs or others at around 13-14%. If you can give him at 10-11%, what is the kind of ROA you will generate on your book? So these are very, very profitable segments. Right now, these guys are focusing on these, which is what I say. Using technology, now they are going to defend their turf from digital companies, as well as they are going to challenge PSU banks, as well as even small finance banks much more strongly, in my opinion, or even large NBFCs. And that is going to enable them to keep growing. And within banking, another area that we find a great opportunity is, one is this large banks, and another is very small financial institutions, but very well executed financial institutions. So typically these guys are in small ticket loans. They might be in business loans of ticket size of 5 to 10 lakhs. They might be in business or affordable housing loan. They might be giving vehicle finance loan like AU is doing. It is not into CV, but it is into tour operators, school vans, these kind of slightly diversified sort of a book. And it is not heavily CV, which is a cyclical business. So you can look into companies, which is what I feel that is a trend that is emerging, and I can see a few opportunities in the space that you have small companies where small financial institutions which have created a good book and are able to underwrite and scale up their business. They might be of a size of around anywhere between 5,000 crore to 15,000 crore, like what I mentioned for AU. And Home First is a 5,000 crore book. In my opinion, which falls into this. But what is the unique thing about these businesses are the ticket size is much granular, and no private sector bank. The first bucket that I mentioned, they are not focusing on this. So you have no competition coming, at least for next 5 years, from private banks, because these are not documented income proof. So you can't, private banks cannot lend to these guys or even PSU banks. Second, these are run through direct model, through branch model, and not through agency. Therefore, profit comes to you. It's not lost to the agencies. And something of an asset, either it's a residential property or it's a vehicle finance, which gives additional comfort for you, because even if there is a default, the loss given default is much lesser. Sometimes for vehicle finance, loss given default is 20-30%. For residential property, it is much lower. So we are not interested in unsecured loans given to in the name of financial inclusiveness to low income people, because that is a high risk model, in my opinion. And we need a good secured model, but granular book. And few businesses are able to do it. And I think those are interesting spaces. So within financial space, you have either this bucket of large private sector banks, and the other bucket is small banks, small companies, small financial institutions, but have a robust business model, and they are not competing with private sector banks, and also highly profitable and growing at least 30%. So the first bucket is growing at 20%. The second bucket is growing at not less than 30%. So these are two areas where trends where we see good financial institutions you can buy, not from 1 to 2 year perspective, at least from a 5-year perspective, invest into them and benefit out of the growth that these companies can deliver. And what you should be mindful of, you should be mindful of the profitability of the existing model, competition in the existing model, and how big the opportunity, which I said, like if an affordable housing company, the housing loans in India is a multi-billion dollar, right? So the companies that we are looking at in affordable housing are not even of a size of more than 5,000 crores. There are some affordable housing guys who are 10,000 crores, but overall opportunity is still very, very big, and they can grow multiple years. The area that they operate are not competitive from the large banks, therefore it's a different case. And each of them operate with a very low cost sort of a branch operation. Don't spend too much on branch and all those stuff, and be very competitive in the market. But the criteria is they should be able to underwrite very good. And COVID, to that extent, gave us a lot of comfort because we could see opportunities and filter out opportunities in this space, particularly the second bucket. And they have not faced too high an NPA cycle during COVID. Then I think so. When we invest into smaller financial institutions, seasoning of the book is a key criteria, right? So here, I think COVID gave an excellent opportunity to see how seasoned it is, in our opinion. So that's the trend, and that's where some of these interesting companies keep coming to us. It is in large caps, mid cap, and small cap, all three areas, predominantly in large and mid cap, I would say. The second trend is there's an interesting one. I think it's last year the opportunity on the digital space was well discussed and discovered. But what I feel is, with the stock prices falling now, people are now questioning this trend itself. So please don't. I think these trends are for long term, I think, and COVID probably helped them in a temporary manner, but I think these trends are there for a long term. Digital penetration in India for various products is at a very, very nascent stage. And if you ask us whether this penetration will increase multifold, yes. In the next 5 years, I see across various categories, the digital penetration in India can go up. In some of the categories, the penetration levels are less than 5%, or even say 2%. In some categories, we have reached 20%, but we have a great chance in some of these smaller categories where the penetration levels are less than 5% to become 30% over the next, say, 7-8 year time period. And some of these companies may not be making profits today, but they are great growth opportunities, in my opinion. So people are getting worried that the stock prices are falling. So is it the story itself different? So don't ever bet on your growth assumptions based on stock prices, or judge the business based on stock prices. The business has to be judged standalone. Yes, these companies came at a very high valuation. That's why we avoided all these issues. And now we are happy that we are able to get all these businesses at almost a 60%, 70% discount from where these companies listed or where they were trading 1 year back, because we are convinced on this trend, and we know that these companies have capability to grow. And if you look at names in the food delivery business or names in the beauty business and all, the penetration level, the number of active users is just 1 crore, 1.5 crores probably. And the number of online shoppers in India has crossed 22 crores. And number of people using cell phones, media users, or even online transactors is around 30 crore in India. So there is a long way to go in terms of growth. And as per capita income increases, as well as the penetration of 5G and all this happens, my sense is a lot of benefit will get thrown, and online penetration for many of the segments will increase multifold. Just given an idea about how India and China looks at this web, if you look at the outer shell is the China one. Although India has the best generation, younger generation population who are tech savvy, I think we are much less penetrated, and the gap compared to India, say China, is much higher across various, let's say, online shoppers to active users in many of these products. So I think this trend is there for companies to capture. It can be captured by a digital company, pure tech company, or it can be captured by a traditional offline company also. So we like two type of companies here. One is pure digital companies, and we like even omni-channel companies who are present. Like, for example, the QSRs. So the QSRs like Jubilant, right now Jubilant is not in the portfolio because we played it out and we exited, but we are seeing similar QSRs now. But imagine how QSRs benefited. QSRs have a very strong offline presence, but they used digital on top of it to bring in a digital delivery model. And that helped profitability to go up substantially higher, because a restaurant business is a 70% gross margin business. So every order they get, in addition to the footfalls that they see on their offline shops, is going to make 70% higher profits to them. So they will benefit immensely by getting online or offline orders. So every company where every QSR or every dine out companies where we see that offline plus the delivery is around 20-30% of the business, profitability is huge in those businesses. But yeah, and probably this can be made use for growth by a QSR chain like a Jubilant or a KFC or a Pizza Hut. Sort of companies, and we are invested into one of the businesses in this space. I will cover about it in the subsequent slide. So digital, I think it's an important area and gives a lot of opportunity. Consumer discretionary is a huge opportunity. I did not talk about per capita income benefit and all, but India's per capita income, I'll talk about two, and you might be having a question like there is an inflation, so how convinced you are? See, just look at the kind of growth in the employee expenses for Nifty 50, 500 employees. It's been a 12.5% growth last year. Even this year there is a growth. So we feel that the urban job as well as urban wage has grown substantially, and therefore the ability to handle the inflation will be much superior in urban centers compared to rural centers as we go through this inflation over the next 6 months time period, in my opinion. So good job growth and good wage inflation, I think, should enable urban consumption to remain strong, particularly the low ticket consumer baskets. So we pay a lot of attention on low ticket consumer baskets. We call it as organized retail. It can be a dine out, it can be a apparel retail chain, it can be a grocery retail chain, but we are fascinated about the retail opportunity in India. So we have some names here which we have invested into, like for example, jewelry, paints, retail, QSR, multiplex, all this interests us, but some of them have got little disrupted due to COVID and therefore had to take a backseat. So like PVR used to be there with us, but now we are having a cautious view on that. We have in some portfolios, but not across all portfolios because the threat of OTT and all is coming through. We used to feel OTT can never threaten the large blockbusters. But of late, blockbusters itself has become an issue. So therefore, it is kind of hurting their numbers. But otherwise, I think if you look at any other business, like for example, QSR, as I explained to you, the offline plus online is much more profitable than a pure online itself. A retail company like Trent, since work from office was there, it had some impact. Now work from home was there, it had some impact. Now work from office has again started. So we are again seeing footfalls coming back to retail, particularly in the urban centers. So if you look at retail, what fascinates me is it's a very, very predictable model. First thing is you are seeing these brands across near you, right? It is not like I need to search for what is working in this country. You just need to step into a mall and you will know what is probably selling by speaking to people across the counter, where you are seeing more footfalls and where you are seeing more attraction. And second point is these businesses, there is a huge opportunity. There are more urbanization that is going to happen and they can keep growing. But the point is every shop that they put, they should be able to make profits within 2 years. That's the next criteria that we keep. So a Titan or a KFC in India, these companies make very high profitability as high as 25%. There is no working capital issue, so the entire money gets reinvested. Let me talk about the scalability. Like KFC in India is 500 stores. In China, it is 8,000 stores. And both the countries population like eating chicken, right? So India will also see such a penetration slowly. So I think from a 500 store operations in India, I think KFC can easily become 1,000 stores in next 3-4 years and become a 2,000 sort of numbers in 10-year time period. A huge amount of growth is possible, but they have to make profits in the existing business to keep reinvesting. That's where our 3Q criteria comes, that you test the business with what sort of ROC they make and whether the cash is available for reinvestment. And look at the management, what they're committing on growth front in terms of store addition. When that is done, the retail model is very, very predictable. And that is how we made money in Titan. Titan, when we bought, was an 100-store operation. Today, it is 400 stores. And they added this either through their own investment or through franchising model. And they are able to scale up and not losing the per store metrics in terms of revenue. And actually, the SSG growth has enabled the per store growth revenue also to go up, like what has happened with Titan, as well as it has happened with Trent also. We have seen the per store metrics go up. When that is happening, then you can sit and enjoy the growth over the next say 5-6 years, and then just relook at it whenever they reduce the growth plans, because store addition itself will give you growth between 10 to 15%, and SSG will give you another 5%. So you can easily identify many retail opportunities with a 20% growth. But be mindful, look at the balance sheet and the management commentary before you do this. So I'll stop here. The other trend where we see companies with such superior growth opportunity is the specialty chemical space. I have covered this partly in the initial commentary, so I will not take too much time here. Let's move to Q&A session.
Sure, Madan, I think this was a very detailed presentation that you gave and kind of very comprehensive. You have more or less covered all the questions also. But broadly, while you were kind of giving your presentation, I was looking at the chat, and I'm again, going back to the chat and trying to, cover some of the questions which you have not yet covered. So one of the questions, which always is kind of asked about overall macro and valuations of India's market, where over last say 6 months, Indian markets have actually shown great resilience to whatever has happened to the overall world markets. And because at the end of the day, recession in US and UK would definitely sooner or later have some impact on India also. So from that point of view, investors trying to invest currently at these levels, obviously some of the businesses and identification of these businesses is good, that you have discussed in terms of quality of financials, business and management. But from the perspective of overall macro environment, in this juncture, I know timing is never possible, and valuations are also fair at the current moment. But because obviously you bring with yourself 20 years of wisdom, and this is one of the most important questions that investors ask, how do you want to attempt this question? What can go wrong over say next 6 months? If you can maybe give some foresight on that.
That's a very tough question, but I think see, I'll tell you, there are I will not have an 100% answer for you on this and how to time it, but I'll give you a certain framework with which we are looking at, and that can, if it helps you, it's good. Because even last 6 months rally has even surprised me, and why it happened also. If I look at around, there are two reasons for it, and one is definitely India's growth has been much superior than many other countries, and no question about it in this period. And many of the leading indicators in India, they have looked green. We track the indicators. We put indicators of around 50 indicators to see what is going right in the Indian economy, right? So when we look at it, last 6 months, majority of them is green or blue, which is a positive indication. That is, every quarter there is an improvement, or year on year there is an improvement, which is happened in India, and that is a fact that we should accept. And there could be a number of reasons that we can say. The reasons why it happened, I think, unlike any other country, India benefited from the IT sector growth for the last 2 years. India also benefited on top of it because there was a large amount of wealth creation in India in the banking and financial services side, and therefore recruitment is happening in the wealth counters as well as banking counters. You can see the kind of attrition rate not just in IT sector, you can see it in banking sector, in financial services sector, and the retail sector right now. And I think the rural is suffering because of high inflation. But predominantly, there are many things which have gone right for last 6 months. But now there is a beginning of some of these indicators showing signs of weakening. They have not turned negative, but they are starting to show weakening. Urban employment is still not weakening. Urban job growth index, people, if you have time, just look at this interesting index, which Naukri Jobs Peak Index. You can look at it. Every month they give what are the kind of they do a survey and then give us what are the kind of job addition has happened across sectors. So there was some blip in last month. This month again there is a huge growth. Last month till 2 months back it was supported by IT. Today it is being supported by retail, BFSI, hospitality, because now post-COVID hospitals have started working. So one of our portfolio stock, Rainbow Healthcare, which is a retail model in an hospital sector, in my opinion, by adding beds continuously, they keep growing, and as a very, very specialized sort of an offering in the pediatric space. This guy was put on hold on the expansion for 2 years because of COVID and all. Now he is again talking about adding beds continuously. next 2-3 years, he might add 30% additional growth from bed addition itself. Not year on year, I'm saying overall point to point. 30% growth can come from just bed addition itself because hospitals are coming out of the post-COVID. So we are seeing job creation across retail, across hospitals, hospitality space, even hotel sectors have started talking about new things. Real estate has started talking about good demand. I think whatever job growth and wage growth that has happened in the urban center, we can be little bit convinced that India's growth may not suffer so much like the other countries due to inflation. Let's keep that in mind. Let's keep that in mind that next 2 years, if you ask me, I can reasonably talk for a 5% growth in India. Whether India will be 7 to 8%, I have doubts. I don't think I am building a portfolio with that perspective. 5% growth looks very much possible. India was having a 4.5% growth pre-COVID. A 5% growth looks possible because we are doing slightly much better than pre-COVID level in the manufacturing space and also in the services space. So therefore, we can expect a decent growth in the around 5% is definitely doable in India. So just keep that in mind. And now then look at what has happened in the market. Market in US has gone below their pre-COVID level. So entire wealth got wiped off from US and all. In India, we are at 50% higher. And every time when there is a global fall, India is not falling. And why it is happening? At least we used to react closer to the US market, but of late we are showing a completely different trajectory. Two things, you can look at the yield also, 10-year yield US and 10-year yield India. Last 6 months, the US yield has moved by 50 bips or higher because Fed is now turned much more hawkish than what it was, say, 6 months back. But India's yield, which was tagging along US yield from an increase point of view, last 6 months is flat. What it is conveying, it is saying that our inflation concerns might have peaked out much earlier than US. And that is giving support to Indian investors and giving even foreign investors a confidence that probably India might, if US already they have increased it by 75 bips yesterday, so they might do another 75 bips probably or even higher than that. For this 150 bips, what RBI might end up doing might be 75 or even 50 because inflation has been brought under some sort of a control in India, or to put it other way, our inflation was always higher and it is not much higher than what its history is. I'm not saying inflation is lower than what it is in US, but our inflation, given our growth of around 5%, is not a big cause of concern compared to US or Europe, where the growth is going to be zero or even negative for Europe. And they also run an inflation of around 5-6%. Then that's a serious cause of concern because that can hurt economy for multiple years going forward. If you run an inflation of 5-6% and then your economy is not growing at, if your economy is not even growing at 1-2%, then you run a great risk of hurting growth for many years to come. So therefore, that is a major concern for those countries to bring down inflation quickly. For India, RBI can be little bit relaxed, little bit. I'm saying it's not like if oil again goes back to 120, then even our hands will be tightened, in my opinion. So therefore, that's a temporary relief that we are getting, in our opinion. That is also a point where FIs are finding India. Third most important point, China has gone through a slowdown. Initially, foreign investors thought it's a temporary slowdown and brought in because of the third term for Mr. Xi Jinping and all this stuff. But slowly they are, when I read recently many of the foreign investors' commentary, they are digesting the fact that China is getting into a low growth zone for a long period to come. So this higher allocation which China had in the MSCI index, there is a fall. Some of this fall can revert. I believe that will revert, but there is a 15% sort of a cut in MSCI weight to China, and 10 to 12% of it has come to India. Some portion of it will go away in the next, say, 1 year or so, but this is a meaningful change in the way asset allocation has happened globally towards India, right? And this is also helped India. and money kept on coming back. As the market fell, money kept on coming back and pushing the valuations up. So now these three factors have helped market to sustain. But what are the three going forward? What can happen to these three factors is the point. First is, I think China, how long they will continue with lockdown, anybody's guess. I don't want to guess here, but I am saying not long they can continue to do the same thing, right? So they will probably come out of it, and therefore at that point of time, when China's markets are trading at single digit PE right now, so they will see some bounce back, and they will see some investors going back, and that will lead to some valuation contraction in India, because today India is trading at 21 times, and particularly mid and small cap. In mid and small cap, I'm seeing we are trading at 27 times 1 year forward, as the earnings are getting cut down. So you need to be a little bit careful when you are playing with some of these mid cap names. Second, where the growth can go from here, I said 5%, but I think a lot of these mid cap companies who are having some export of growth, that is slowing down slowly. Therefore, the earnings momentum might slow down. So some of them are trading at 40 times, 50 times. Now, for many of these industrial companies which have some export growth and all happening at this point of time, I think easily we are giving 40 times, 50 times. So there is a little bit of greed. The greed that was there in tech companies last year, I see that greed in industrial companies. So it's a very nice spot right now to be. You have India domestic story, you have a global export story, and you have China slowdown story. So China plus one story. So all the stories are enabling for Indian investors to probably overpay to some of these manufacturing companies, in my opinion. So those are the segments where I see a lot of valuation froth. Those can get adjusted, in my opinion. So while the overall valuation might remain 18 times, 20 times, it can see some moderate correction to even 16 times. That's where we were, say, 2018-19. But there are a lot of froth within the sectors. So those have to be readjusted. So I feel investors will do well by sticking to sectors where there is growth and available at a reasonable price, and they should not be on a hope continuously. When there is a global growth coming down, don't expect too much on the capex cycle, in my opinion, because that's a story which is running in a big way. When the China is slowing down, when US is slowing down, what will be the need for additional capital or capacity in steel or metals or energy? So you have to be careful about it. So I am seeing a lot of gungo that is going on that front. So you need to be a little careful about those expectations. Otherwise, I think India 5% growth, and based on that sectors that you will see growth, you can bet upon it. And if the valuations are on your side, okay, little bit be careful on the valuation side. That's what I keep telling myself. Don't overpay for companies, at least for next 6 months. If you have too much of IP stocks, tone down a bit and look at opportunity. But for the first time, my portfolio, my portfolio used to be at a premium to broader market index. So mine used to be at around 28 times, 27 times, compared to 20 times of Nifty in the past, or even when Nifty is 15, 16 times, I used to be at around 24 times, something like that. So for the first time in the last 3 years, I'm seeing my portfolio's PE 1 year forward is at around 20 times, closer to Nifty PE. And Nifty earnings growth is 10%, and our portfolio earnings growth is 20%. So I feel if you are very, very stock selective, you have a great chance to create alpha over the next 2-3 year time period. Here, if you want to time the market, the best option should be come through an STP, spread it out. But I think because of this volatility, you get some stocks at a throwaway price. So if the money is in the hands of fund manager, it is great for you. But I think if you want to reduce the risk, you can come through an STP route. But also saying avoid India is also not great. You can wait for the 10% correction. If you get it, superb. But I think some of these growth stories are there. So market is going to be concentrated in terms of performance in the next 2-3 years. Unlike last 2 years where there was a broader performing sort of a scenario, right? You out of 100 stocks, 90 stocks would have given you a reasonable return. But going forward, out of 100 stocks, even 20-25 stocks give you return, it will be a big achievement. So you have to rethink on where you are positioning, whether diversified portfolios will help you, or concentrated portfolios will help you. That's a call you have to take. If you're going for concentrated, you have to go for quality. If you're going for diversified, you need to look for how the value gets generated when it is a diversified portfolio, because number of participants are going to be lesser.
Thank you so much, Madan. I think this has been a very elaborative answer. And I think if I have to sum it up, in my opinion, investing is a decision which is a relative decision. And when we're talking about India, obviously India, given the fact that, China is under struggle, US is under, inflation as well as rising interest rates. Obviously, India has a relative better positioning in terms of, having a better advantage of a perception, as well as obviously it is being backed by real growth. And ahead of us, the election year in 2024 is also kind of a non-event, maybe for the first time, right? So obviously all these factors are ensuring that if today we have learned that a good business can command higher PE, like we have seen good businesses, be it Asian Paints or Pidilite, if they have commanded high PEs, India can also command high PE if India is perceived as a good investment destination. And all these factors are kind of making India to be perceived as a good investment destination. And obviously equity markets work on forward thinking. 23rd March 2020 was maybe the point when India's lockdown was announced, but that was the lowest point. After that, market only went up. So market is trying to discount maybe 1 year, now. So market is trying to understand, market is buoyant over last 6 months is because market is trying to kind of, work 1 year ahead. And keeping all these things in mind, relatively India is having that advantage. And absolutely, we are also of the view that this is a decade which is absolutely going to be India's decade. And not only decade, many, I would say learned economists have been saying this century belongs to India. And obviously not all businesses make sense. Not all sectors make sense. And that sector rotation does happen. That is where, we have professionals like you who kind of, help do portfolio management, come with long-term horizon, come with positive attitude, and obviously, come with risk appetite, because investing in equity is risky, and higher the risk, higher the return is a norm that all of us understand. And yes, I also agree, with Madan one when he says that maybe staggering over next 6 months when the scenario is more of an uncertain than more of a risk, because risks are all known and understood, but uncertainty is not known. So from that point of view, obviously, staggering is not a bad idea. It's a good idea. And whenever one invests, keeping a horizon of first 500 days as a no worry period, because first 500 days, nobody knows what's going to happen. And then time value of money plays in and your portfolio starts to generate returns. So come with a long-term horizon and keep in mind all these facts, think positive, and absolutely, making 15% above returns in equities over a longer term is definitely possible, given our informed style of investing, our, quality, risk, and consistency focused approach. Thank you everyone once again, for logging in today. And thank you, Madan, for your time, for sparing us for this webinar. Thank you.
Thanks, Kamal. Always nice talking to you, and thank you all for logging in for this evening presentation. Thank you so much.
My pleasure.